Hi there and welcome to the Stop Club podcast, coming to you from the top floor of MyWallSt HQ here in Dublin, Ireland. This week's episode is a bumper jargon busters, where we're going to talk about when to sell stock, the importance of earnings reports for long-term investors, and how dollar cost averaging might work for you. So before we start this week's episode, I just want to say that we're actually recording this podcast a few days earlier than usual, and for that reason we're going to skip the recent news section, because with the way things are happening now, it'll probably be outdated very, very fast. So we're going to skip recent news and we're going to give you a bumper jargon busters this week. But to start off with, Rory, the company we're talking about, this is where we have a look at a company in our app that you think doesn't get the attention it deserves. What company do you want to talk about this week?
Well, first of all, we're going to have to change this segment pretty soon because we're running out of companies we never talk about.
We've talked about all the companies.
Yeah, we need to start mixing it up a bit. Yeah, we can do companies we talk about too much.
Tesla.
Facebook. Now the company I'm going to talk about is IDEX Laboratories. Recent enough addition to our app. They are the leaders in pet diagnostic equipment. For those not familiar with the business, they have a few different segments, but the big one, the one that investors probably want to focus on most, is their vet lab business. So these are basically diagnostic machines that the company sell into veterinary practices for a one-off fee. And then they sell them the testing strips on a per-use basis. So it's a classic kind of razor and blade model, which you'll all be familiar with from the likes of Gillette or Kerr Green Mountain or Nespresso. And that equals long-term recurring revenue, which we always love to see.
Yeah.
And these strips basically, they test for a wide range of underlying conditions. That and basically give instant results back to the vet.
Okay.
So the company reported a few weeks ago they saw 15% organic growth in their vet lab consumables. That's on a constant currency basis, so they're facing some currency headwinds, but still great organic growth. They have a 20% year-over-year increase in their global premium instrument installed base. So they're seeing really strong international demand, and this is one of the best businesses I think to be invested in if you believe that pet ownership and spending on pets is a long-term secular trend. So 68% of households in the US currently own a pet. That's up from 56% in 1988. And Americans spend about $70 billion a year on their pets. That's largely on food, but veterinary care is number two, and it's the fastest growing segment. Here's a fun fact I found while researching this. It's estimated that people spent $480 million last year on costumes for their pets.
Costumes?
Yeah. Halloween costumes for Instagram. Does anyone follow? Maeve's not here. Maeve would be the perfect person to have on this week to talk about this. Pets in costumes on Instagram.
Maeve is going to regret missing this podcast.
But like animals have their own Instagram accounts now. Maeve's dog has an Instagram account.
Really?
Yeah, great Instagram account.
Give it a shout out there.
I can't remember the actual...
Frank.
It's Frank, but I don't know what the actual not Ticker God. Been working in this business too long.
We'll include it in the show notes.
Yeah, put it in the show notes. Frank's Instagram account.
But just when you're talking about that, Rory, I remember, I don't know if this was your hunch or this was research you cited before, but that you mentioned before that millennials, because millennials are waiting longer and longer to have kids, that this is why such a massive amount of money is now being spent on pets, that pets are kind of replacing kids.
Yeah, you're going to make me repeat a term that I really wish I wouldn't have to, which is fur babies. Is what they refer to them as.
Sounds awful.
Yeah, so millennials, we know, are waiting longer and longer to get married for various reasons, being more career focused. And so, instead of having the kind of the commitment of a child, they're opting instead to buy pets, which is still a big commitment.
Yeah, and as a knock-on effect of that, then spending more on veterinary costs.
Having smaller families as well. They end up, if you're a pet in a family of 6 children, you probably don't get as much attention as if you're a pet.
In a fur baby.
Fur baby in a family of 1 or 2 children. This has been a trend that's been going on for about 15 years now. It's been growing rapidly in the US. Europe's kind of catching up very rapidly as well. They reckon IDEX reckon they'll bring in about $2.4 billion this year. It's a 10% increase on last year's numbers. I think what you're going to see is those numbers are going to start accelerating, not decelerating, even though the company's quite big. They also have a wonderful management team led by a guy called Jonathan Ayers. He's not a founder, but he's been at the job since 2002, and he really does treat this business like an owner. He's given up cash payments in favour of stocks many times in the past, and he owns close to 2% of the business, which is really unusual for someone who's not a founding member of a business this size. So that's IDEX Laboratories. It's up 20% since we added it. about 6 months ago, I think, and great business to get involved in.
And would they have any competitors in their field?
Yeah, there's competitors. So one of their segments is reference labs. So so vets taking blood tests and sending them off to be tested and getting the results back. There's a couple of competitors in that space. One of them was their biggest rival was recently acquired by Mars. And then there's various other businesses that do testing on animals, and they also have a livestock business. So there's a bit of competition there. But really, in terms of the desktop test kits that they're selling out, they are the leaders. So great business.
So pop quiz: how much have you spent in your life personally on pet care? Not the procurement of a pet, but its OPEX, the ongoing upkeep of, personally now, not your family, not your folks, not back at home, but in your life now as an adult.
Mine would be zero. I've never had my own pet. Like, we've got family pets, we've had many family pets, and there's probably been a lot of money spent on them. But personally, like, I live in a very small apartment, so I don't really have a pet.
Yeah, I mean, me either. But if I asked my father that question, he'd probably flip this desk over.
And if Maeve was here, that average would shoot right on up. And mine is very low. We haven't had a dog and we haven't had a cat. We've had more micro pets, I guess, micro hamsters, goldfish, that kind of stuff. But I think a dog is headed our way this summer, so I'd imagine I'll be all about IDEX in about a year from now.
But like, we have a family dog, my parents do, and he was sick there a few years ago, and it's at a time like that, you like, obviously I love my dog, but you might not see them as an extension of your family until they get sick, and then there's you would put out a lot of money just for whatever they need, surgery and things like that. And you do hear, I know Trupanion is another company, we have pet insurance, and that's another massively growing field. And it's when it comes down to the hard times like that, you find out how much money you will spend on a pet. Yeah,
it's actually sorry to cut you off there. There's actually a psychological thing where people spend more, or give more attention to things they have to look after them themselves. So
the vulnerability, I suppose.
Yeah, it's like they can't do it themselves. So when a pet owner has to look after something sick, it's like it will put huge amounts of money behind it. Probably more money than they put into their own healthcare, or more attention than they put into their own healthcare. And it's just this company's riding the wave of that.
Cool. So that was the company we never talk about, and that was IDEX. The ticker symbol is Rory.
It's IDXX.
Cool. So as I said at the start of the show, we're going to give you an extra long Jargon Busters this week. For this Jargon Busters, we've decided to tackle, rather than taking individual questions, we've decided to tackle some of the most commonly asked questions we get here at MyWallSt about investing. So the kind of broad strokes, the most frequent questions that come in for us. So the first one we have here is 100% the most frequent, I think. It's when to sell.
Can I take that one?
Yeah.
My most admired investor, who I've had the fortune of knowing personally, is David Gardner, who's one of the co-founders of The Motley Fool. Long before MyWallSt was born, I was reading and following David's thought leadership as a retail investor. And as mentioned in our last podcast, I passed on some of the brilliant opportunities that he spotted and pointed out like 20 years ago, such as the Amazon stock that I passed on while lying on a beach as I guffawed at its, I think it was $6 or $8 billion valuation. So having the privilege and advantage of standing on the shoulder of giants, I and we as a business have learned from a study that David conducted on every single one of his buy and particularly his sell recommendations across 25 years of running newsletter services. And that study therefore has the advantage of big data, or at the very least large data, a lot of data, and also data over 2+ decades.
Yeah.
So we're talking about very real insights based on behavior, specifically sell behavior. So in order to prepare to answer this question, I looked at a study that David and his team conducted under Stock Advisor service 5 years ago, and his average return in that service was around, well, it was very high, like 210% per stock. However, had he never sold a single stock from that service, it would instead be 261% returns per stock. And he again ran the same study on his co-founding brother's sell decisions and had a similar finding, that had his brother Tom never sold the stock, he too, his average would also be up. So the point is that looking and standing on the shoulder of giants, or looking from the shoulder of giants, we have learned, I've observed, that selling with a service is not often the best thing to do.
Yeah.
In my own personal life, I have repeatedly said here, and to the two of you and to anyone else who cares to listen, that all the worst decisions I've made as an investor were sells, because I'll generally move to the sell button in my own personal trough of disillusionment, which is usually when the stock has just done nothing but shed value, when very often the opposite was the right action to take, which is buy more.
Yeah.
So I'm not trying to apply big rules to individual decisions, because actually what we're talking about is a storyboard for each individual stock that you own. But if we do look at the big story, never selling is an easy strategy that big data supports on improving your overall returns. So looking at David's rule breaker service, again, he conducted a study at the same point in time with similar results. So it's inaccurate for me to say that you should never sell anything, but we have learned from greats, and we here at MyWallSt will figure a way to tell our valued customers when we think selling can yield short-term gains, or at least when not to buy a particular stock in our app. But for now, we're living the immortal words of Warren Buffett, who said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And MyWallSt is not even 5 years old yet.
Yeah.
So we are living good practice. So when it comes to the product that we have built with such care, it's clear we haven't sold any stock. Now, 10 or maybe 11 stocks have been bought out from under our feet, of which 9 of them were big winners for our subscribers. And we know, and we keep an acute eye on those stocks that haven't won since we tapped them. And we are leaning on big data and big learnings from bigger businesses that have been around longer than us, and using that data to support our belief that never selling is the best strategy.
So when we say, because it's nearly the unofficial motto here at MyWallSt, never sell, it's more of a mindset than a literal instruction. Is that fair to say that if you're going into a position with this never sell mindset, if you're going to buy it, as Warren Buffett said, you have to go in with the idea of holding for at least 10 years. So that's where the never sell comes. But it's not actual practical advice. You obviously have to sell some stocks at some point to realize some gain.
Unquestionably so, and there are going to be stock. I mean, we say there's no angels on Wall Street, or whatever religious equivalent you care to impose on your investments. But no one out there is watching the stocks you've bought to make sure that you will at least get the price you paid back at some point in the future. And there are stocks that you'll buy that inevitably become dogs, and they fall 99% and won't claw their way back up. I think of a stock I owned 20 plus years ago called JDS Uniphase, which did fiber optical switching equipment and a whole bunch of other equivalent geeky stuff, and it actually fell 99%. And in order for it to grow from that point all the way back to what I paid, it would have had to grow hundreds fold. And I at that time I decided to dump it, and it did grow multiple fold from there, but that was a dog, and I could see that it wasn't going to get its way back to the highs I paid. So there are individual stories that require, I suppose, an individual case study, but I think most investors will enjoy far better returns if they just decide a broad rule, which is I'm never selling anything.
But on like in the on a practical side, when you do sell them, is there any kind of triggers where you go like, I don't want to own this stock anymore?
Absolutely. I mean, my number one reason now for selling a stock is there's been a strategic drift, or they're not doing what they set out to do, or the reason I bought into the business has changed.
So like when you buy into a company, you obviously really believe in their future trajectory, or what management says their future path is. So if that changes, obviously it's not the same company you've invested in at that point.
Are they addressing an opportunity with a product, or opportunities with products? And if they decide that they're chasing something new, or indeed chasing something new with something new, if you know what I mean. It's a different investment, you know. So Roy just spoke about IDEX, and if we heard that IDEX was moving into pet retreats, you know, pet hotels, and
they'd have an investor in Dave Redmond anyway.
They would. And Mavis really going to regret missing today's episode. But there no doubt that is a diversified product that kind of is in their family, but it is a new thing to consider, and we are considering IDEX through the lens that Rory explained. And I think I pay far more attention to those type of things than the quarterly numbers, which keep rolling around every 12 weeks and are a focus of attention, and they get a huge amount of heat because they're easy. I mean, numbers are easy to evaluate because you stick them on a weighing scales beside the quarter before's numbers or the year ago quarter's numbers. Like, numbers are supremely left-brained activity, whereas we're right-brained investors, where we are going more with the art than the science.
I remember you saying something to me, I think when I just started working here, which is in terms of when to sell. I don't know where you stole this from, but it was, you said something like, imagine your broker accidentally sold all your shares and called you the next day and said, look, sorry I did that, whoops, which ones would you buy back instantly? And the ones that you wouldn't buy back, it's not a sign that you need to sell them, but possibly a sign that you need to reconsider.
I stole that from my own life experience.
Okay. Fair enough.
And that is something I contemplate, and I kept an Excel spreadsheet for years on end, with the tickers of the stocks I own on the left-hand column, and I had a fixed date every month where I would answer that very question, which was, if all were accidentally sold, which ones would I rebuy?
Yeah.
And if you keep answering yes, well then you should stick with it through thinking. Then if there's a sequence of months where you're not sure, it's a no, you could consider it for selling rather. But I don't make a sell decision quickly. It takes probably a year to get there, because I contemplate it for the longest time, because I know that long-term investing works. I've seen it. I should really do a count on the total number of stocks I've owned since I was in college. I'd say it's in the top end of the hundreds. It shouldn't be, you know. But I'd say before I was 30, I'd owned 80% of the stocks that I have owned to this point in my life, and I'm 44 now.
Yeah. That's an important point too, is taking the emotion out of a sell. Rory, I know you've spoken about that before, that is it Jason Moser maybe said before, that if you're considering selling a stock, go to bed. It's kind of have a think about it.
Paraphrasing here, but he said, look at it again in 3 days and see how you feel. The times when I've sold stock, it's usually been just dragging for months, where you just kind of get sick of looking at it. It's just,
Yes, there is that effect, and I have sold stocks and never looked back on ones I just couldn't bear the sight of any longer, and that is answering the same question in a different way. You just you've lost faith, you don't believe in it, you don't care to see this thing in your line of sight going forward.
Rory, you recently wrote an expert opinion piece about this.
I did, yeah. It kind of summarises what Emma just said there.
Yeah, it's a few of the practical things, if you want to sell a stock, kind of questions I suppose to ask yourself before you make that.
So just practical questions to ask yourself, and decide if you're going to sell, why you're selling, and are you going to regret this sell? Are you going to keep watching the stock after you sell it? That's usually a sign that you
probably shouldn't.
You probably shouldn't.
Yeah. Cool. So that was about selling. The next thing I want to ask about, and Emma, something you mentioned briefly there, is earnings reports. So we're coming out of the tail end of earnings season now. And it's a time a lot of people get very hyped up, and they're seeing how companies have performed over the last 12 weeks. Emma, you've spoken before that you're not a fan of the quarterly earnings report cycle, but it's still a good check-in on how a company's getting on, kind of working towards the goals they've set out. So when you are looking at an earnings report of a company, what are the things you are looking for?
I'd almost go as far as to say I resent quarterly reports, because they almost demand that you take a look at them. And when you own 20 plus stocks, as I do in my folio, or indeed in this business we are managing 100 plus stocks, you can't ignore it. But I'd go, we're professionals, it's our job to watch it, but retail investors, I shouldn't be presented with this like fire hose of information. It's just wrong.
Yeah.
And President Trump has asked of the SEC I think it's the SEC or maybe FINRA, probably SEC, for that rule to change. It's mandatory. If you list your business on a US exchange, it's not discretionary. You must do a certain level of reporting every quarter.
It's different here in Europe, isn't it?
It is, yeah. And depending on the exchange, I think where management can slip up in the US is providing quarterly guidance. They can. I don't think they're mandatorily obliged to provide guidance.
No.
They are.
iRobot doesn't it?
Exactly. So I admire more those companies. They say, well, here's what we'll have done by the end of this financial year, and we're on track. And that's a more grown-up conversation, but it creates a huge pressure. I mean, as the CEO and founder of this business, I have conversations with shareholders in MyWallSt, and rightfully I answer all their questions about how we're doing, and I do so on a quarterly basis. And I have found that the pace of updates, it comes at you quickly.
Yeah.
It just comes very, very quickly.
I was going to say, when you said the end of earnings season, I didn't think there was an end anymore. They all just seem to stretch into each other now.
It's never
That's
ending.
right, yeah.
It used to be Ulta's report that we used to go, oh yes, we're done. But now it's like there's another one the next week and it all starts over again.
You get kind of 2 weeks in the middle.
It also says that, I think it also puts incredible pressure on managers to hit short-term targets.
Yeah.
You can't, like, if you're running a business and you're trying to think of it with a 5-10 year time horizon, to have to hit targets every single 12 weeks is just totally dilutes that. And if we talk about wanting to own a stock for 10 years, as you should be thinking, that's 40 quarters you're going to own this company for. So one of them isn't going to be the change in the entire thing. It's not something you should worry too much about.
So back to the question, but what do you look for? So we saw there, maybe if you want to take Chipotle as an example, so Chipotle's last quarter report was really good. We saw same store sales up and things like that, and I think it was a good reflection of the overall movement of the company back towards its kind of its good times, if you want to put it like that. So is it kind of a good check-in, but not pay too much weight to it?
The word you use there is trajectory. That's the important word there. It's not what happened in that report. It's to see a trend forming over a period of time that you want to check in on. You want to see that it's going in the right direction. It's not, you don't have to, if you miss your numbers by 5-10%, it's not the end of the world. It's whether you're continuously going in a certain direction. And the few times that you do really have to dig into them, when you see a stock kind of violently react to a bad earnings report and you do dig in, what you're looking for there is, is this a major dent in the business, or is this a slip? And I think you can figure out a lot of that from looking at what management have said about the quarter.
In the earnings call.
The earnings call. The earnings call is really good. If something's gone really badly, going into the earnings call and just listening to the tone of management, listening to the questions that the analysts are putting at them, and listening to the tone of the responses, that's a good kind of barometer of how the business is going. I think you can gain a lot from that.
Yeah.
Elaborating on that, sorry, James, what I look for very truthfully is the day after the quarterly report, I just check in on the stock price, which invariably is up or down, which is the very first barometer on how the overall market has interpreted that news. I mean, we three very often would see a stock that's not in our app just jump or drop wildly, and we'd say, what the heck happened in Acme last night? And it was, they reported and they hit their numbers. So it is, it really, for me, it provides a view of how the market currently sees the business. I don't go a whole lot deeper than that unless there's something fundamental. If we see a business move, as Roy said, wildly up or down 10 or 20% after a quarter, something material has happened. But when you see a few percent up or down, it's just another day at the races, I'm afraid.
Okay, cool. The last thing we want to talk about here in Jargon Busters is dollar cost averaging. So, Emmett, do you want to explain what it is maybe and
Sure.
why people use it as an investing strategy?
The dollar cost averaging is a strategy that allows an investor to buy the same dollar amount of an investment on regular intervals. So the purchases occur irrespective of what the asset in our world, the stock's price is. So you might decide in a dollar cost averaging strategy that you are going to buy 100 books worth of Disney on the first Tuesday of every month. And that would go down as a dollar cost averaging strategy. Now that traditional, if you call it, web-based retail investing for the masses has been on air for 20 years. In other words, the ability for any of us here at this room to buy stocks for the last 20 years is out there. There's enough data out there to see how dollar cost averaging has actually played out for real people who stuck with it rigorously. And I think that's really where we need to go. How has the world fared with dollar cost averaging? Because I could sit here and tell you what the textbooks say dollar cost averaging does, but I think the proof of the pudding is in the eating, as they say on this side of the Atlantic. And to be honest, I found an equal number of pros versus cons for the approach. I mean, the pro of dollar cost averaging is you can pre-commit to a strategy and it takes the thinking out of it, and when the stock is down, your $100 buys more of it, and when the stock's up, it buys less of it, and over the long run you're a winner. But we are thinkers. Like, we're human beings, we're investors. This mindless $100 a month, it just is very hard to slavishly adhere to one of these strategies without superimposing something you've seen or heard or observed. And there's plenty of platforms that will allow you to set it and forget it. So what I can only do is bring it back to my own life's experience, and I have dollar cost averaged, but not in a textbook way. The manner in which I have built my stock portfolio is, as we've discussed many times before, I keep an eye on all the stocks in my folio, and if I have a notional amount, and for the first 10-ish years of my investing life, I had a notional amount, let's call it $1,000.
Yeah.
And I'm not saying that this was the best approach, but it was an approach. But if, for example, I bought $1,000 worth of Under Armour and found a few months later that I was below $1,000, I would decide, do I still believe in Under Armour? Do I still like it? Do I still think it's going to be one of the mega brands of the future?
Yeah.
And I'd top it up to $1,000. I would add more money to bring it back to my notional number of the minimum I have invested in it. There's probably a term for this, but it seems like the cousin of dollar cost averaging, and it served me well because it's a hybrid. It's the Bride of Frankenstein's approach to dollar cost averaging. I'm applying my thinking on top of the philosophy that your book buys more when the stock is on sale.
Yeah.
I think for novice investors or got people getting started into it, it's a good approach to take, especially when you see stocks at kind of all-time highs. You get a lot of people asking, should I invest in this stock? It's at an all-time high. Should I not wait for a pullback? And I've given out about all-time highs, the term, a few times now. But if you are worried, if you want to invest in a company, you think, oh God, it's had a great run, and dollar cost averaging is a good way of building a position in that stock over time, and you will mitigate the potential time risk that it'll drop the next day.
Okay, cool. That was really helpful. So that was our extended jargon busters. Remember, if you have any questions or kind of topics you want us to talk about, get in touch. I'll give the contact details at the end. Just want to point out that we've loads of new stuff in the MyWallSt app at the moment. As we've already mentioned, Rory's written a new expert opinion piece which talks about the topic of selling our stocks as long-term investors. Fans of Jargon Busters will also like one of our new features, the MyWallSt mailbag. This is where we share some of the most interesting questions our investment team has got over the past month that have been asked by the MyWallSt community. So you can check all of this plus our new stocks, our new stock of the month. That's all in the MyWallSt app right now. So we're moving on to the elevator pitch now. Emmett, question for you. Outside of Warren Buffett, who's your biggest investing hero?
David Gardner.
Outside of David Gardner.
Besides David Gardner, Peter Lynch.
Peter Lynch. So, author of One Up on Wall Street. It's probably one of the biggest influences here amongst the whole investing team in MyWallSt, that book. I think it's kind of given to every new person on their first day to read. So in particular, Lynch was a big advocate for boring companies. So he often said that the more unattractive a company sounds, the better of an investment opportunity it was. So with that in mind, the elevator pitch I've asked you both to prepare for this week is the most boring company you'd like to add to the MyWallSt app. So this is going to be a very, very exciting elevator ride. Who wants to go first?
How long have we got?
I'll give you 30 seconds each.
This is going to feel like an hour.
60 seconds
I
each.
need longer than that because I have a bit of explaining.
Do you want my 30 seconds? I'm only kidding. Right, okay.
Emmett.
So, well, I'll go first because I will stick to 30 seconds.
Okay.
I'm going to go with Kinder Morgan, who are the US, the nation's largest owner and operator of natural gas pipelines. And they also have a whole bunch of terminals, which is great big yokes that you store gas, oil, and other energy products in. And the reason I like Kinder Morgan is it has an asset that's very, very hard to replicate, which is pipes through under the ground. And it's paying a great dividend, which is nearly 5%, 4.9%, which they boosted very recently. And it looks like their income is going to grow. So I think it looks like a boring business that pays a great dividend of nearly 5% with upside potential in the stock.
Okay.
Is yolks a technical term?
It's probably a Dublin vernacular, which is when you've lost a word, you go, yeah, thank you for that, Rory. A yoke is anything, any object that you can touch. So I guess I should have said terminal. They have a terminal business, which is storage facilities.
Very good. Rory.
Okay, I just need a little bit more time on this because there's a bit of explain to do at the start. The company I'm pitching isn't actually a public company at the moment. It's a subsidiary of a public company, and they're splitting them up next year.
Okay.
So the bigger company is United Technologies, and the company they're going to spin off is Otis, which is the maker of elevators.
Oh yeah.
Perfect for an elevator
We've all
pitch.
seen it. Everybody has seen
Synergy.
it.
Yeah.
Oh, brilliant. Yes.
They're the biggest
perfect elevator pitch.
They are a 160-year-old company. Its founder, Elisha Otis, didn't invent the elevator, but he did invent something almost as important, which was the elevator safety brake. And his demonstration of that brake at the New York World Fair in 1853 paved the way for the first skyscrapers because people were terrified of getting on them until they saw this. So the parent company, United Technologies, have admittedly kind of themselves failed to invest in the business over the last number of years. That saw them lose some ground to their biggest rivals, Kona, which is a Finnish company. So I think as a standalone company, they'll fare better. They've the best name in the brand by far. They're known for safety. They've the highest operating margins in the industry. And yeah, they've got that really sticky business model where they put in an elevator and just get, decades of revenue out of it.
Sounds good. So I'm not sure what I'm supposed to judge the companies on here. Is it supposed to be which is most boring or which is the better investment?
Do both.
Do both. Yeah.
So, well, Emmett, I think yours is definitely the most boring company.
Thank you very much. I have that effect on people.
Rory, I'm going to give it to you for the best investment. I think I like the synergy of an elevator company and an elevator pitch too.
More elevator companies coming next week.
We should ask our listener base to pitch ideas for a pitch.
Yeah.
So what would they like elevator pitches on? And try and keep it quirky, folks.
There's another, sorry to bore everyone, but there's another elevator company that actually is listed. It's called Schindler. It's the third biggest. It's listed on the Swiss Stock Exchange. So it's a Swiss company.
Yeah.
And you can go and see their returns over the last, I think they were listed in 1997.
Yeah.
Stocks were about 15-fold.
Really?
Oh, go away.
Yeah.
Elevators are good businesses.
I suppose you're not going to take an elevator out.
No, that's for sure.
There was another company you mentioned, Emmett, that has been delisted recently.
Chicago Bridge and Iron. I used to love it. It's a brilliant stock. It was delisted a year ago. I think it merged or was acquired. And as soon as he said, hey, let's pitch the most boring company, I was like, oh, CBI.
What does Chicago Bridge and Iron do?
They do big, great steel structures and help people build things of immense, colossal value made out of iron.
And bridges.
And bridges,
Chicago.
Yeah. I actually looked it up. They do more than bridges, but still.
That was their bread and butter.
That's their bread and butter.
So that's about it from this week's Stock Club. Don't forget about all the great new stuff in the MyWallSt app at the moment. And if there's anything you want us to discuss or explain on the next episode, make sure to get in touch. You probably know where to get us now. You can reach us on Twitter at MyWallSt or email us at pod@mywallstreet.com. That's pod@mywallstreet.com. If you enjoy Stock Club, please review it on iTunes or whatever podcast player you listen to it on, as it really helps us out. With that, we'll talk to you in 2 weeks. Happy investing.